Hello, everyone, and welcome to another Wall Street from Main Street podcast. Today, we have a returning guest, Rick Rule from Sprott Money. Rick, welcome back.
It's always a pleasure. Thanks for the opportunity to talk to your audience.
Great. So first thing I want to get into is you talk about, it's the first book you recommend, The Intelligent Investor. And when I read it, it had a good outline and a good strategy used. And I thought it was made for the resource sector. Don't chase Mr. Market. Let it come to you, especially with dividend stocks where oil and gas companies pay generous ones. It says don't chase a dividend. Make sure it has good value, good cash flows, and good assets to support it. Why do you think a lot of value investors don't participate in the resource sector?
Well, I think, first of all, that there's a real scarcity of value investors overall. Pick a sector. Value investors don't seem to predominate, and they particularly don't seem to predominate after 20 years of progressively lower interest rates, where in general market securities an ape and a dartboard have done reasonably well. I guess with regards specifically to value investors in resources, value investors did predominate in the resource sector in the 50s and 60s. What happened beginning in the 1970s, that incredible bull run that we had in natural resources, is that investors' expectations as to how you got paid in resources changed. When the gold price moved from $35 an ounce to $850 an ounce, ironically, the most inefficient producers, the ones that exhibited the least value-like characteristics, did the best. In a rapidly rising commodity price environment, what gets rewarded are, ironically, the high-cost producers, the inefficient guys, because their margins widen out faster. So the resource business came to be dominated by people that asked commodity producers to exhibit leverage to the commodity price, in other words, to be marginal. And I think the overall poor corporate performance in the natural resource sector over the last 20 years has been a consequence of that, really. You see value investors like myself predominate in natural resources in very bad markets, like the markets that we've been in for the last 18 months. But in a bull market, the thesis that Wall Street and, in fact, Main Street adheres to is a very non-value-oriented thesis. It's somewhere between a momentum thesis and a leverage to commodity price thesis. That being said, I think value investors do better over time in resources than any other class of investor because they give back less in declines, and these are very cyclical businesses.
All right. And one other thing is, in terms of being a value investor in the resource sector, what would you say is the most important thing to take away from intelligent investor?
Well, you can't narrow it down to one. You have to give me two.
Okay, I'll give you two.
The two are Mr. Market, which I think is an absolutely brilliant chapter, where Ben Graham describes the market really as a source of transactional value rather than a source of information. I think describing the market as a partner in a business that's a manic depressive is absolutely a brilliant way of describing a market. And I think the other chapter has to do with a definable margin of safety. In a capital-intensive cyclical business, looking at your downside as carefully as you look at your upside is absolutely critical. And Graham's description of the margin of safety, I think, is absolutely brilliant. And I think more investors and speculators need to spend more time on margin of safety, stress testing their investments as an example against development costs, against rise in interest rates, against a decrease in commodities prices, an increase in taxation and royalty rates. And Ben Graham talked about all of those things in a way that was very important. His discussion of dividends is, of course, important too, although I would put it in a tier 2 category. What he was trying to say is that companies sometimes raise dividends although they can't afford them to increase their stock price and ironically lower their cost of capital. My friend Doug Casey was famously quoted as saying, with regards to dividends, make sure they're earned dividends. And he further described earned dividends as outward manifestations of inward grace, a quote that I still love.
And one other thing is you actually brought up about taxes and royalties. One thing I wanted to ask you is in terms of investing. When a lot of generic people talk about geopolitical risk, they have a viewpoint of generally the West is more stable. What is your viewpoint of geopolitical risk?
I think the West is more stable, but I think you often pay too much for the alleged lack of geopolitical risk in the West. I have noticed that many of my peers, many of my professional peers tend to think that money that is stolen from you via changes in tax law or changes in legislation, in other words, crudely, money that's stolen from you by white people in English according to the rule of law, is somehow less gone than money that's stolen from you in a less elliptical fashion. I've pointed out many times a fact which is true, which is that my worst experience with political risk took place in the People's Republic of California. So the idea that I could suffer a multi-million-dollar political risk personally in the state that I was born in and live in today, and I should be more concerned about the Congo, is problematic for me. I think that people assign risk also so based on their nature of the understanding of the risk. And if you are familiar with the nature of risk in the United States and Canada, as an example, via taxation, it appears less dramatic to you than risks in places that you are less familiar with. That's all I can think of. My experience, certainly in resources, has been that, ironically, you have less overall political risk in countries that absolutely need resource development than you do in wealthier countries where they can afford to be more stupid than other jurisdictions can.
Yeah, I definitely agree, and I definitely see. I definitely think if you look at TransCanada, I think stability to them isn't necessarily a good thing, considering they've been trying to build a pipeline for I don't know how long, and it's gone nowhere. So if you want to count that as stable, I think that's a stable environment. And I was wondering also about investing. The other last thing is how important would you say is always maintaining a cash position to being a successful investor, especially in the resource sector?
It depends on how speculative you want to be. Much of what I do is highly speculative. And the consequence of that is that you have to have capital available to take advantage of volatility because you're acting in the shorter term. And you have to have capital available to participate in private placements when they are on order. If your investing style is different, if you are in bear markets buying the very best of the senior companies and holding them through the long term, then having cash is less important. It really depends on whether your style is opportunistic and speculative or value and duration oriented. The value and duration oriented investor, for the value and duration oriented investor, cash holdings are less important than for the speculator.
All right, so you would say cash positions are more important for like the junior resource sector than they would be buying like Gold Corps or Silver Wheat.
Well, I would probably yes. I mean, yes, that's true. I was thinking Gold Corp and Silver Wheaton probably as components in portfolios of companies that were in fact even larger than that. The BHPs, the Rio Tintos, the Exxons, and the Totals of the world.
All right. So now I want to switch subjects. You're actually the first person I heard talk about water being in a bull market and as a great opportunity. And since your last podcast I had you on, there's actually been a shortage of California. And I have a question. Has water moved from being a long-term thing to possibly being a medium-term thing now, or is it still a long-term thing? It's just California at the moment screwing up.
If California, and to a little bit of a lesser degree, the Intermountain West, doesn't have a very, very, very wet April, and I note there's 2 weeks left in this April, the water problem will begin to manifest itself this year. You will not see price responses or market responses because the legislation associated with water is so strange. Water isn't allocated by a market, it's allocated politically. Our old joke was, in free market physics, water would flow uphill to votes, but uphill to money, to markets, but water in fact flows downhill to votes. And you're going to need to change a lot of legislation because water is allocated rather than by utility. It's allocated to political power. Now, the problem is going to be that water has been way, way, way over-allocated. You can allocate all you want, but if there isn't any water, the person that has the allocation is going to turn a gate valve and not get anything out of it. That happened 3 weeks ago in California, where I believe 7 Central Valley irrigation districts got zero allocation. They got no water. What that means is that this year, tens of thousands of acres of California permanent crops, meaning trees, things that require a long time to mature and harvest, are going to die. So we've begun to see the impact of water in the economy. The impact of water in the economy will have to change the political equation in one way, shape, or form in the state, because the only way you can allocate water over time is via a market. That won't happen this year because it's going to be a very, very, very ugly ugly fight, but the stage has been set. You know, one of the things I'd like to call your viewers' attention to, particularly your younger viewers who weren't around, is that the last good drought we had in California was in 1977, and it had a lot of economic impact. But the truth is, it was only 1 year long, and there were a couple of other truths too that people need to consider. The most important of which is that there were 12 million fewer people in California in 1977 competing for the water. There are now 12 million more straws in the sponge, so to speak. The second thing that people need to consider is that in 1977, California had the ability to overdraft or overtake its Colorado River allocation. Our ability to do that is gone now as a consequence of population growth throughout the Intermountain West, be it Salt Lake or Denver or Las Vegas or Phoenix or Tucson. So this time, assuming that we go into the second year of a drought, the drought is going to be real and the consequences are going to be real. And the returns to people who own water that can be sold are going to be dramatic.
All right, so in terms of investing, it seems like it's still long term, but the problem is now starting to manifest in myself. Did I correctly interpret that?
I think so, John. With the caveat that now in my 60s, my view of long term and yours might be different. It's ironic how as I age, I get more patient. If somebody tells me that something is going to take 3 years to play out, I think now, well, you know, I've done that 20 times before. That's not such a long term.
Yeah, I gotta say, I think I'm pretty patient. I can definitely wait. So
Good.
My boss told me I have time on my side. So
you do.
Yeah. So next thing I want to switch to is the uranium, the energy market in general. And right now, uranium, a lot of people expected the price to start rising this year. It hasn't, despite the megatons, megawatts deal expiring. Right now, it still seems like a good opportunity because it's below cost of production. But do you have updates on the uranium or the megatons, megawatts deal of why it's not increasing price?
I think in the very near term, there will be continued price weakness in uranium. People underestimated the impact of Japan taking its nuclear fleet off, which had the impact of taking about 20 million pounds of demand out of a 190 million pound market. It was quite profound. And until two things happen, one, the Chinese are, of course, putting on one reactor a quarter. So as that demand comes in the market, coupled with the restart of the Japanese nuclear fleet, which we suspect happens in earnest in 2015, the market will tighten up. But until then, the market's going to be very tough, very soft. The market's oversupplied. Now, with regards to megatons to megawatts, that supply didn't go away. The Russians have not quit supplying uranium, including down-blended weapons-grade uranium. What's happened is that the Russians have decided not to give the Americans the arbitrage and the treatment profits from it. The Russians would like to be full-service uranium suppliers themselves, where they supply basic uranium, they supply fuel rods, they recycle fuel rods, and ultimately where they dispose of nuclear waste. In the very near term, this isn't a particularly viable market strategy as a consequence of the outcry around the world associated with Russian activities in Ukraine and Crimea. But one would expect that the Russian plan is a very good plan, and ultimately, and that uranium supplies won't be particularly affected, nor, of course, will the reactors care whether or not the uranium that they burn was downblended and fabricated into rod in the U.S. versus the USSR.
All right. And one question is, in terms of the uranium space, this is just a general question, not for specific individuals, because there could be a lot of people might misconstrue this. But do you think some people, in terms of playing uranium, might be better off just using Uranium Participation Corp or Cameco? Because
I absolutely do. I absolutely do. If you think that the uranium price is going to go up, buy the uranium, don't buy the stocks. Buy the stock because you think there's some particular reason why the stock is going to go up. And if you are an investor prepared to hold a stock for 5 or 6 years, absolutely concentrate on the bigger ones. And the only really big one around is Cameco. So by all means, if you're an investor, not a speculator, look to the top of the pack. Look at Uranium Participation Corp or look at Cameco.
All right. And last thing about energy is I just wanted to get an update because you thought about natural gas as a great buy, and it's gone up substantially since our interview. I believe it was in November. Do you think it's still a good buy, or is it just it's not contrarian anymore? It's gone up a lot.
My own positions in the U.S. natural gas equities have been sold. What I suspected would happen over a year and a half happened over half a year. They exceeded every level of greed I had for them in the short term. So they're gone. My suspicion is that you will ultimately see a baseline price for natural gas in the sort of $4.50 or even slightly higher range. Although before we get to that point in time, gas could obviously gap lower. The prices that we have in the United States today are barely sufficient for the industry to earn its cost of capital. But the industry raised so much capital over the last 10 years that there's a substantial amount of capital they could cannibalize. One thing that happened, as an example, was that companies drilled very hard to hold leases and then didn't complete the wells. They fulfilled the contract that they had with the landowner so that they wouldn't have to write off the lease acquisition cost, but they didn't complete the wells. Now, with gas selling at $4.50 and the forward strip so attractive, people are selling into the futures market, completing the wells, and being assured of an economic outcome. So it could be that in the very near term that we return to an oversupply situation. And we shouldn't forget the fact that we had an unusually cold winter in some parts of the year. The polar vortex was something that absolutely was an answer to oil men's dreams in a short term, and we can't count on that recurring.
Yeah, it definitely was a cold winter. I definitely can. We got snow so much in D.C. We are not used to snow. I will say that. Last topic I wanted to get into was what Sprott's really known for is precious metals. We had basically opened the year up with a big launch, and it's corrected now. What do you see for the next, I would say, 6 months? Do you see sort of a choppy sideways, or do you see it going up but just very slowly? Or do you see a bull market coming soon?
No, I personally do think that we're in a recovering market in the precious metals, but I think the absence of a capitulation sell-off, a very, very, very sharp down move in gold and silver, precludes probably a very dramatic near-term upside. I think that we're going to have a saucer-shaped recovery, higher highs and higher lows to be sure, but lots of volatility. I will say that the price decline that we've seen very recently is one that one would expect. Market recoveries need to consolidate. These advances need to consolidate. And what we've seen is a very, very healthy consolidation. People who have experience in precious metals understand that these markets can go up 10 or 12 or 15 or 20% and down by the same amount for no particular reason, although the press always ascribes reasons to them, like Crimea. In fact, these are extremely volatile markets, and people who don't have the stomach for the volatility should avoid them.
Yeah. And one other thing is, in terms of the capitulation, it's very unusual we didn't, I haven't been around for many of the markets, but why do you think we haven't seen the capitulation? Do you think it's possible we could see one this summer?
I think we could have an anomalous event, a Black Swan, a 2008 style event that would give us capitulation. My suspicion is that we haven't had capitulation because the interest rates are so artificially low and there is so much short-term money looking for opportunity. My suspicion is that quantitative easing, or counterfeiting as I call it, ironically subsidized the precious metals commodity and the precious metals speculative equities. I think it's ironic because I don't think it was set out to do that, but a rising tide certainly floats all ships. And I'm intrigued by your question because I do think that there is a possibility, I'm not saying it's going to happen, but I do think that there's a possibility that there are other asynchronous events, black swans, things that we haven't thought out there that could torpedo investor confidence and that could lead to tightness in liquidity, which in turn wrecks the markets for speculative volatile assets like the kind that we're talking about.
Yeah, well, if you look at it, there are, at least what I think is, there's Russia and Putin and Obama. We know about those tensions. The high-frequency trading debate with Michael Lewis. So there could be a rise of a new legislation rule forcing companies to raise cash. Do you think is there any way, people talk about the Volcker rule, do you think that could stimulate capitulation or any type of...
I'm more concerned about something that I think is actually inevitable, which is the Fed losing control of interest rates. If you saw the long-term interest rate or the mortgage rate 150 or 200 basis points higher than it is today, there would be carnage in the bond market. There would be carnage in the single-family residential market. The fact that there was carnage in the bond market would make the bond rates a little bit more attractive, although people would be terrified of them and might divert some money from more speculative markets like equities. That, in turn, when you look at the continued over-leverage of the balance sheets in the international banking community, if you price their bond portfolios down as a consequence of rising interest rates, you could have continuing nervousness about bank failures. I would say another thing that concerns me, other than what I think is the inevitable rising of interest rates over time, would be the realization in the United States that both public and private pensions and pension plans are substantially underfunded. They're underfunded even according to model, and the model often assumes a 7 or 8% portfolio return against realizations that are much lower than that. Another set of circumstances could be continued municipal defaults, a la Detroit. And I note that there are other political subdivisions, including states, that are having difficulties matching their ability to raise money, i.e. tax, relative to their ability to spend money, which is always greater. So I'm not saying that any of these things are going to happen, but they normally happen when you don't expect them to happen. That's why they're called black swans. And the possibility that one of those destabilizing events could occur, which would precipitate capitulation, is something that all of your listeners need to think about. It's precisely the type of circumstance that Ben Graham talked about, and we quoted at the beginning of this interview about the margin of safety. You shouldn't count on these things, but you should consider them in making your investments.
All right. Yeah, definitely. And of course, from what I think is, I'm hoping that capitulation comes because that's a great buying opportunity. So,
if you have the cash and the courage to stay the trade, you will do well in a capitulation.
So, well, anyway, Rick, thanks for coming on. I appreciated your time. If people want to find out more about you or do business with Sprott, how can they do so? I
would welcome your readers and listeners to either call us at 800-477-7853, or probably easier for them, come to our website, which is www.sprottglobal.com. On the front page of that, you'll see a subscribe button. Click on the subscribe, and you will get absolutely free, 3 times a week, the internal blog from Sprott called Sprott's Thoughts, which is the best thinkers in the Sprott organization, including Mark Faber, Eric Sprott, John Embry, myself, and the other analysts and portfolio managers at Sprott. I guarantee you'll get your money's worth because it's absolutely free. All right. Thank you for coming on, and I encourage everyone to go there. I subscribe to all of them, and I enjoy them. So thank you. You're welcome.